Institute. We are also a member of CFA Societies Canada, which promotes advocacy efforts to our regulators. In addition, CFA Society Winnipeg provides our over 300 members with professional development and educational opportunities, job placement services, and membership networking events. I'm very excited today to be joined by Peter Perkins, Partner, Global Strategy at MRB Partners, to provide some insight into the US election that I am sure we will be hearing a lot about over the next 25 days. But just before I introduce Peter, I'd like to mention that we will be having a question and answer period following the presentation. To ask a question, please at any time during or following the presentation, type your question into the chat box feature in Zoom, and I will do my best at the end to ask the questions on your behalf. Now to introduce our speaker today. Peter Perkins is a founding partner at MRB Partners. He has extensive experience both as a strategist and economist. Peter focuses on asset allocation issues and strategy, key drivers of the global economy and capital markets, as well as investment opportunities and risks. He works closely with MRB clients on tactical and strategic asset allocation, assisting them in interpreting and translating macroeconomic and policy factors into a tailored investment strategy. Peter speaks widely at conferences, seminars, and client meetings, and regularly participates in investment committee meetings for select investment management firms. Over his career, Peter has covered all major asset classes and regions and worked in the US, Hong Kong, Mexico, and Canada before recently relocating to the UK. Prior to forming MRB, he was managing editor at BCA Research Inc., focusing on tactical asset allocation and supporting major clients. Peter is from Washington, DC, and has a Master of Economics from Pennsylvania State University and BA in Economics from University of Maryland. And with that, Peter, I will pass it on to you.
All right, thank you very much, Brendan, and thank you everybody for participating. I guess it's safe to say that we do live in interesting times politically, and of course it's been, quite turbulent over the past couple of days. So what I want to do is walk you through our view of the election and some of the related issues. So just from an agenda standpoint, I want to talk briefly about the fundamentals of the election. Many of you may know them, but just to clarify them, identify what's at stake, really for the economy and sectors that may be affected, particularly in the equity market. Give you some guidelines on handicapping the election itself, talk about the relationship of the economy to the election and the importance. Focus on key swing states, because that's how the election is going to be determined, and then talk about the capital market implications briefly. So let me start with, and again, you may know this, but it's important to just reiterate it. The US doesn't have really a national election. It has a series of state elections, and that is a crucial variable. As you're aware, the presidential winner is determined by the Electoral College. So you have to win 270 votes in the Electoral College to be elected president. And the voting, is depending on the individual states. It has nothing to do with the national popularity voting or whatever. And as a result of that, and as I mentioned there at the bottom, national polls, they're indicative. They may tell us something. We follow them closely, but they don't necessarily tell us about who's going to win, because it doesn't matter. At the end of the day, if you live in the state of New York, or you live in the state of Alabama, or you live in the state of California, it doesn't matter, because it's the winner of the election in your state is going to win by an overwhelming margin. So the election issues, very simply, first and foremost, this is a referendum on President Trump. That's generally the case for an incumbent, but it is particularly the case for Mr. Trump. The impact of his health is still unclear on the election process. We'll see. There has been some polling, but we'll have to see how that plays out. We still don't know fully, and particularly given that he and many people in his administration have gotten COVID, how COVID is going to play out over the next couple of weeks. It's been increasing in the United States a bit, so that could have an impact. It's also important when evaluating the election to understand that who controls Congress beginning next year is going to be extremely important in what the president is able to do, whether that's Mr. Biden or Mr. Trump. As always, I mean, I think this is underappreciated, and I'm here to talk to you about, the presidency and the election and its impact on the capital markets. But the reality is that the state of the economy and state of capital markets at the start of, a presidential term is really the most important driver, rather than what their policies are or anything else. So I'm going to contextualize that, and then just give you some perspective on how policy is likely to evolve under a Biden or Trump administration. So what is at stake, which is the main question of the whole discussion here, really, and that is at the macro level. There's some pretty big picture stuff for both candidates. Protecting the economic recovery and solidifying the economic recovery is job number 1, 2, 3, 4, and 5, and anything else is really going to be put on the back burner until that is accomplished. Both, are going to be emphasizing that. For Trump, it's just a continuation of the strategies and policies that were in place before COVID struck. For Mr. Biden, he really wants to redirect the emphasis of growth in the economy. So there's a big difference on that front. On the corporate tax front, substantial differences. Mr. Trump is going to push for additional corporate tax cuts, as well as additional personal income tax cuts. Mr. Biden advocates raising corporate taxes and raising taxes on upper income people as well. So, completely divergent tax policies, both from the corporate and personal income tax level. Deregulation, or regulation overall, let's call it. Mr. Biden advocates re-regulating a number of things, or restoring regulations to the way they were before Mr. Trump came into office. For Mr. Trump, he wants to continue the deregulation process. On the federal budget, they really have wildly different overarching views, but both are willing to use fiscal resources to buttress the economy in the short term. Neither of them has told the American public how they're going to deal with the budget position and federal debt in the longer term. Eventually that pressure is going to emerge. So neither has even acknowledged it realistically. On the issue of racial equality, arguably there's a lot of differences, at least rhetorically. This is a slow grind for either. I think it's more a matter of impression and presentation than it's going to be of outright policies per se. But this is going to be an important issue for the foreseeable future, regardless of who wins. At the sector issue, and this is really more geared towards, let's call it the equity market, although it's important for credit markets as well, there are also a number of dramatic differences. In the energy sector, obviously Mr. Trump is pro-fossil fuels, Mr. Biden is in favor of alternative energy. Now, that's not as important an issue for the equity market as it used to be, because market capitalization of the energy sector, let's say in the S&P 500, something like 4%, where it was over 10% 5 years ago. So it's not as important as it was, but it's still, a meaningful signal for the market overall. On the healthcare side, they have, of course, very, very different views. This is very important because healthcare is not only the largest sector of the U.S. economy, but it's the second largest sector in the S&P 500. So their divergent views, could have a significant impact on the economy through the healthcare sector and also on the equity market. Obviously, Mr. Biden, favors expanding the public role via the Affordable Care Act, and the Republicans under Mr. Trump have advocated, terminating the Affordable Care Act. So, again, wildly divergent views there. It is important to recognize that the Trump administration and the Republicans have not offered an alternative to the Affordable Care Act yet, so we can't really assess what the implications of that would be. Finance is very important as well, obviously for the economy as well as for the equity market. Mr. Biden favors reinstating some of the regulations that were in place before Mr. Trump took office, and Mr. Trump wants to continue the deregulation of the financial sector. Tech, both parties are in favor of curtailing some of the power of the big tech sectors. The Department of Justice, representing the Trump administration today, has opened lawsuits, obviously, against or challenges to Google. Both sides favor some data use restrictions. I think the general perception is that the Democrats under Biden would be more aggressive in pursuing it, but I think it's a little bit unclear. And it's always important to recognize that, when the U.S. is involved in a tech Cold War that may get hot with China, neither side wants to really threaten the tech sector. They're going to be, I think, careful about how they re-regulate that or regulate that in the years ahead. On the trade side, on the surface, there's a lot of similarities because the Democrats historically have been in favor of trade tariffs and efforts against China to, and other parties to reduce the trade deficit. And obviously, Mr. Trump has pursued those as well. I think the key difference is the approach that they will take. As Canadians, you're aware, Mr. Trump uses, sort of carries a big stick and bashes it around. Mr. Biden wants to restore relations with, key alliances, including Canada. Doesn't necessarily mean they have wildly divergent views of how to treat trade when it comes down to negotiations themselves. But I think there's it's the approach that will be different. So there's a lot of differences at sectors that are going to matter for the equity market as well as the economy overall. In terms of handicapping the election, a couple of things are worth noting. First, incumbency is a very powerful force. Now we're, very late in the election cycle, so it's not the same as it was before the crisis or 6 months ago when you're assessing it. But, 10 out of the 15 incumbents who've run re-election have won in the past 120 years. So it bestows a great advantage on an incumbent, and that in this case is Mr. Trump. The Electoral College itself favors or overweights small rural states as opposed to the larger urban population centers. That favors Mr. Trump quite significantly, as I'll touch upon in a moment. Presidential popularity and status, as I mentioned, it's not crucial really. Mr. Trump, however, has had a low overall approval rating for his entire term, really. But now he has a low overall approval rating in many of the key swing states, and that's important. It does reduce other advantages that Mr. Trump would have otherwise had. On the economic side, if you go back to pre-COVID, Mr. Trump saw this as his real ace card, right? The economy was doing well, employment was growing, and all of that kind of stuff. The unemployment rate was low. Obviously, those advantages have faded in the following the COVID crisis. But Mr. Trump still heralds the economy and the strength of the economy before it as a key attribute of his or advantage that he has. And on the base side, in trying to understand the base, I think it is, we have to acknowledge Mr. Trump's base, 38 or 40% of the population is probably rock solid and isn't going anywhere. Presumably they'll turn out as well. For Mr. Biden, it's a little bit more difficult to assess what the turnout ratio is going to be, not just nationally, but in key states, because he needs those people to show up in select states, the swing states, for him to win the election. And swing voters are going to be the determinant in this election. So base favors Mr. Trump right now, depending upon what the turnout is for Mr. Biden. So just going very briefly backwards, just to underpin the changing dynamics, and you're aware of this, but when you look back pre-crisis, the stock market was doing well. In fairness, the stock market was continuing a trend that started in 2010, so it was interrupted by the COVID case, but it wasn't really on a different trajectory per se than it had been in the prior decade. And you can see from the employment chart, it too was on a steadily rising trajectory. This dotted line there is for when Mr. Trump took office. Obviously, there's been an implosion in employment. The extent to which Mr. Trump is going to be blamed for that remains to be seen. But when you look at these things, they were benefits for Mr. Trump prior to the crisis. Particularly the employment picture is obviously a detriment now, or at least historically would have been. The other thing that's interesting about the economy is that the US ISM Manufacturing Index, which is one of the most popular tools for asset allocation, and in fact, one of the most popular signals that the market has for the guide to the US economy overall, has also historically been very useful for assessing the election outcome. And that's particularly the case because many of the swing states are in the industrial heartland of the United States near the Great Lakes. So not too far from you. And so when you look at the ISM Manufacturing Index as a proxy for things, when it's weak, it tends to hurt an incumbent president, and when it's strong, it tends to help. Now, 3 months ago or 4 months ago, it was very weak as a reaction, in an immediate reaction to the COVID crisis. It has recovered quite dramatically. So it's a bit tricky to read this. One reference point, though, is in 2016, when Trump won the election and he won Wisconsin, he won Michigan, and he won Pennsylvania. It was in the middle of a manufacturing sector recession. It was pretty modest recession, but it was nonetheless a recession. I think that had an important impact. We'll see whether or not this thing proves useful this time. But if it weren't for COVID, I think this would still be a good barometer. Of course, the ISM wouldn't be where it is today. It would be lower if it weren't for COVID, because we've had a big bounce back temporarily. So let me focus on the swing states. As you're aware, there's a handful of them. Here I've listed Florida, which is the big one at 29 electoral votes, Pennsylvania, Ohio, which wasn't in play last time, but has come back into play, Michigan, North Carolina, Arizona, and Wisconsin. Those are the things to focus on. When you look at the polling and other consensus estimates today, and this is, you can see on the screen, based on 270 to win as a consolidator of information, the Democrats have 188 safe seats plus 101 likely or lean seats. Since you need 270 to win, if Mr. Biden wins the seats that he either has are characterized as safe or likely or lean, he's going to win, right? He doesn't really need any of the other swing states to win. It shouldn't say it doesn't need any swing states, because some of the 188 and likely lean include swing states, but he doesn't need to get anything that isn't already leaning in his direction. The Republicans have 88 safe seats and 75 likely or lean, so they need to win. They need to win the overwhelming majority of the swing states in order to win. Mr. Trump won all of the swing states in 2016, so that was the crucial variable. Florida is always important given its size and given that it's always close, or has always been close in recent years. But I still think chances are good that Michigan, Pennsylvania, and/or Wisconsin are going to determine the outcome. And as a guideline, for those of you who stay up to watch the U.S. election, as opposed to, I don't know when the hockey season starts, so it may not have started by then. But the fact of the matter is that you can focus initially on Florida and Pennsylvania because they're in the Eastern time zone, so they report early. If Mr. Trump must win Florida, or he's done. And if Biden wins Pennsylvania, he's going to be on a pretty clear path to victory. So those two states can tell us a lot. If Pennsylvania and Florida go Mr. Trump's direction, he's going to win. If they go Biden's direction, he's going to win. If they split, you're likely to be up late at night. We may not know even on the morning of November 4th. All right, so I'm going to leave this aside just to make a general point. When you look at those industrial swing states, because COVID has been very important historically, trying to understand the economic health of those swing states has been very important. It's hard to judge right now to what extent the economic fortunes of those states are going to govern the voting outcome, but historically, where we are today would normally favor an opposition candidate rather than an incumbent. And in this case, those states are currently favoring him, and I'll touch upon that in a second. But they're still swing states, and that's still what matters. And it's close enough economically that they are still swing states. All right, so taking those four main states and just looking at where we are, I'm just presenting a couple of perspectives, right? So one is a set of polling averages that consolidates a number of different polls that are taken on Real Clear Politics. You can see from that Mr. Biden has a lead in each of those four states. In Florida, it's only 2%, so it's small. The margin of error of these polls is give or take around 3 or 4%. So in Florida, the 2% Biden lead is within the margin of error. So, it's very close. For the others, Biden has a more substantial lead. And, these are kind of fluid because the day-to-day changes and so forth, and a lot obviously is happening politically. But right now, Biden has a lead in all those states, and in 3 of them, he's got a lead that is greater than the margin of error. So he's in a very advantageous position right now. In the betting markets, the predicted, which is crucial if you're not familiar with these, the thing is these are what are called winner-take-all markets. So you can win Wisconsin by one vote, and you win Wisconsin. So the bettors are betting on who's going to win, not whether or not it's going to be 2% or 3% or what the advantage is. In this case, Mr. Biden is expected to win Florida, Michigan, Pennsylvania, and Wisconsin, and the latter three by decisive margin. So the market is saying, you know, a small win for Mr. Biden is a win, and we put high odds that he's going to win. Now, just as a reference point, things don't quite add to 100 cents on the dollar for, you know, various quirks, but, you know, there's still time for the polls to change. We've got, you know, 2 weeks to the election, or a little more than 2 weeks to the election. So, you know, there is some time to change, and there's two debates, potentially still two debates upcoming. You know, we can talk about that later as necessary, but a couple of things that are important, just, you know, working with the election map in the United States, it's worth looking at some of the potential outcomes. So for Mr. Trump, as I said, you know, he needs to win the safe, likely, and lean states that he has now, and he's got to win some combination, let's say Arizona, Florida, North Carolina, and then either Michigan or Pennsylvania if he's going to win, right? So he's got to win. So Arizona, Florida, and North Carolina are all swing states, and he's got to win one of the Michigan or Pennsylvania, for example, in order to win. So that's his path to victory. For Mr. Biden, he just has to win the states he's leading in today. But there are a number of alternative outcomes, all of which would probably be scary, to be honest. But, you know, you can craft a scenario where Biden effectively loses by one vote, because 270 to 268 is, of course, only one electoral college vote difference. And two states, Nebraska and Maine, split their votes. They're the only two states where it's not winner take all. They split their votes. And so one vote under this circumstance, Biden loses all the swing states, and he loses Wisconsin, and he loses a vote in Maine, and he could lose by what is effectively 270 to 268. As close as it could be. The flip side is Mr. Trump, it's easy to craft a scenario where Mr. Trump loses by a similar amount by losing a vote, for example, in the other split state, which is Nebraska. There's a number of other states that could swing. Texas is really kind of a pink state rather than a red state. Georgia's a pink state. Iowa's a pink state. Minnesota, which is a blue state, is a light blue state. New Hampshire, you know, so there's other states that could swing, but the main swing states are the ones I've identified. We could easily, very easily, have a circumstance that is a repeat of 2016, where Mr. Trump wins the electoral college vote, but loses the popular vote. And this time, you know, he lost the popular vote in 2016 by 3 million votes. He could easily lose by 5 million or more votes this time and still win the election. So, of course, that would just increase polarization and tensions across the United States dramatically. The other thing is, of course, we could have a tie in the electoral college vote, not difficult to come up with that. And we could have a delayed vote count, because if you're overseas like I am and you had a mail-in ballot, or, you know, even if you're voting in the United States and you have a mail-in ballot, many of those, you know, historically, as long as they arrive by the date of the election, they're supposed to be counted. So, you know, counting those could create a lot of uncertainty, because we won't know on November 3rd, we might not know on November 4th, and it may take a while to count those votes. So there's a lot of circumstances in which we could see, you know, a very close race, and, you know, a nail biter and extraordinary tension, both for capital markets and for the population as a whole. I would assume that living right next door, you know, be a lot of anxiety in Winnipeg as well. So just taking a very simple perspective on the two, you can you know, pretty much simplify this race to, you know, there's for Mr. Trump, and it's an election about Mr. Trump. He's got these two elements. One is continuity. The market understands and people know who Mr. Trump is. So there's a certain degree of continuity. And for the equity market, that's important, or for capital markets, that's important. To know that, we lived through this last 4 years, we have some idea of what we're going to be living through in the future. Now, the challenge is, of course, that Mr. Trump is a highly disruptive economic agent. So, you know, markets like predictability, that normally favors an incumbent. In this case, less so, because Mr. Trump is a disruptor and he's often reactive. But the market does like his corporate and personal tax cuts, and the market likes his deregulation strategies. Mr. Trump is very market friendly, and he cares about it. He talks about the market all the time. So, you know, that is important. The flip side is that Mr. Biden, of course, represents change from an administration, and there would be lots of changes, across agencies and so forth. He's less conventionally market friendly than Mr. Trump. I don't think Mr. Biden goes home every night and says, wow, I know what the stock market did because I've looked at it 12 times during the day. But by the same token, he's much more predictable. Now, it depends on the makeup of Congress and the progressive wing of the Democratic Party. But Biden is an institutionalist. He's been in Washington for years. People are going to know, broadly speaking, what they're going to get, or at least they think they're going to know, because he tends to work off the same platform that existed beforehand, whether you think that's good or bad. Right. So a couple of points on Mr. Biden, because you know Mr. Trump. So as I said, Mr. Biden and Mr. Trump, but Mr. Biden is going to be emphasizing, combating COVID and ensuring the economic recovery stays on track. That's job one for either candidate. It is important to identify Biden's a moderate insider. He's not a radical leftist or whatever. Of course, he may have a progressive wing that he has to deal with, but he himself is a moderate insider. He has, of course, tremendous legislative experience. He's lived his life in Washington, first as a senator and subsequently as a vice president. He wants to work with and knows how to work with Congress. And that's important because neither Mr. Trump nor, in fact, Mr. Obama were effective at working with Congress. One would assume Mr. Biden's going to be much more effective at being able to do so. He's made friends on both sides of the aisle in the past. My own sense is, and this is my own sense, but I think it's
I apologize. We seem to be having some technical difficulties here. Just bear with us for a moment, please. It appears that Peter's computer is just having a difficulty for a second, and he's going to try to log back on. So if you don't mind holding on, he will be right back. Thank you. It looks like, Peter, you're back.
Yep, sorry about that. I have no earthly idea what happened.
We'll see if we can get your presentation back up here and continue on.
So, can you, I just want to verify that it's back up.
It is up, yes.
Okay. My apologies, everyone. Suddenly I got a message that there was some sort of security error and it shut me down. So my apologies for the disruption. Just, going back, just so that as a reminder that, there's going to be a lot of pressure on Mr. Biden or a Biden administration from the progressive wing of the Democratic Party, but he's not going to risk the economy. That's the number one objective, because that's about employment and the overlying or underlying health of the economy. So there may be a lot of things that he wants to achieve and pressures that he's going to be experiencing, but getting the economy back on track is going to be job number one. As I said, he's less sensitive to the equity market than Mr. Trump. So equity investors should acknowledge that. He's just not as concerned about it as Mr. Trump has been. Taxes are going to go up, whether those are corporate taxes, personal income taxes, capital gains taxes, or any other things. Now, when they go up is subject to economic conditions. Again, I don't think Mr. Biden is likely to jeopardize the economy, but eventually a Biden administration would include meaningful increases in taxes. Of course, the reality is, my belief, given the budgetary challenges the U.S. is going to be facing, taxes are going to go up no matter which administration is there. But Mr. Biden is going to be doing it more aggressively, at least initially, than Mr. Trump will have to do. The other priorities, I think working with restoring relations with allies is going to be important. I think that's good, obviously, for Canada. Getting back in the WTO, the WHO, re-strengthening relationships around the world with Europe and so forth, I think are going to be key planks of Mr. Biden's international strategy. And domestically, reinforcing and ensuring that the Affordable Care Act is secure and strengthened is going to be a main priority for Mr. Biden. Overarching point there at the end, I think, is important to stress. Biden's 77, he'll be 78 if he assumes office. He sees himself as a placeholder, not the driver of a different and new America based on some philosophy that he has. He's a placeholder. The COVID circumstance has given him a set of opportunities that he wouldn't have had otherwise, but he doesn't see himself as a transformation agent. Really, he sees himself as a representative of the Democratic Party with legislative capability. There may be significant change, but half of that is because of the COVID circumstance. So a couple of other perspectives on Mr. Trump. There is some policy uncertainty if Trump wins. He could, be very aggressive if he wins, because, he already owns the Republican Party, but he would own it lock, stock, barrel, and everything else if he's able to craft a win out of this, particularly at this point. It looks like he's going to become more aggressive if he does win, and I would imagine it'll, revive his overall sentiment if he's able to pull out a win. If he does win and he moves in the aggressive direction, which I think is the most likely outcome, there's going to be additional tariffs on China, Europe, Japan, and possibly even Canada. restrictions on portfolio and direct investment abroad. Now that may affect you less than it affects many Americans, but it's going to be an important signal for investors worldwide if the US starts to impose those, and I would expect them to do so. The reality is it's happening anyway. It's been happening for a number of years, but greater isolationism seems inevitable if Mr. Trump wins. That's the direction the US is heading. It's the direction of the world, really, but it's going to be accelerated if Mr. Trump. Program, everybody will love that, and of course Mr. Biden wants to do the same, but the market will applaud the passage of a significant infrastructure program. And Mr. Trump has indicated he wants to cut payroll taxes and some other taxes on lower income groups, which may placate some lower income groups. The market would like it because tax cuts are tax cuts, and they think it's good for the economy. So there are some things that are on the more moderate side that he might undertake. As I said, congressional control is very important when you're assessing the implications of the election, because the split government, while the market says it likes that, that's not what the history has suggested in terms of performance. A sweep by the Democrats, which increasingly looks possible, if not probable, is likely to bring a pretty significant change in macro and sector policies, obviously more than if the Democrats just win the presidency and retain the House. A sweep by Republicans, although at this point it seems highly unlikely, I suspect would bring a very aggressive set of policy moves by the Trump administration, albeit in the same direction they've been on in the past couple of years. It'd be tougher to be Canada under that circumstance if there were a sweep by the Republican Party. If the Democrats win the presidency, if Biden wins, I think the odds are now more than 50-50 that the Democrats would win the Senate. So markets so far are comforted by the fact that Biden might win, and maybe even comforted that he might win, that the Democrats might win the Senate. But I think they'll also be unnerved by a couple of things. Again, a Republican sweep would just, I suspect would turbocharge a lot of the things that have been in place for the Trump administration. So very quickly, the Senate map today, the Republicans have a 53-47 advantage. There are 35 seats up for re-election. Right now, there's about 7 that are toss-up states. It's 50-50 as to, well, it's not 50, it's 46-46, let's call it, give or take 46 or 47 each on the Senate electoral map today with a bunch of toss-ups. So it's 50-50 as to whichever way it might go. Again, because the presidency is leaning towards Biden, I suspect you've got a slight advantage for the Democrats, but right now it's a toss-up. Right? The House is going to go to the Democrats almost certainly. I'm going to skip this. This is just a couple of points to make, which is really that historically stocks have done better under Democratic presidents than under Republican presidents, and done better under a split Congress than, done worse under a split Congress than under a unified Congress. So the fact of the matter is that market myths haven't really been borne out by historical fact, but they're market myths nonetheless, and you would expect the market to react that way. So, as a reminder, it's the economy that drives the market first and foremost. We expect the US economy to be expanding next year, pretty moderate pace. There's a lot of challenges to overcome. Right now, or for many months, the market has looked like they're exuberant about the outlook for the US economy. It's tough slogging ahead. An upbeat case for equities is that earnings are going to recover by the end of next year to where they were at the end of last year. That's an upbeat, that's an optimistic case for earnings. It's not implausible, but that's already built, that's already the consensus expectation. So, it's priced in. Stocks are expensive by historical standards. There may be debate among, CFA members, investors worldwide and so forth. You can cut it any way you want, but the reality is that US stocks are expensive maybe not as expensive as some measures suggest, but they are expensive. When you take a simple math formula, PE times E to determine the stock price, neither of them gives you a particularly buoyant outlook for stocks. They give you a middling outlook. Now, of course, things can change, but that's the economics of things today. Treasuries, of course, are very expensive. Credit is more attractive than treasuries, but credit is even expensive. It's going to be very, very difficult to turn a fixed income portfolio to a contribution to a multi-asset portfolio over the course of 2021 in an economic recovery scenario. And while equities are in an upturn, particularly in the United States, I still think it's premature, even though we're starting an economic recovery process, to believe that equities have started a multi-year bull run. So a couple of long-term changes. I think we should respect that while COVID, we've bounced back relatively quickly and there's a lot of uncertainty, maybe we'll get a vaccine next year or whatever, there's some long-run damage that has been created by COVID, both for the service sector, but everybody is sacrificing some degree of productivity growth in the future in order to secure access to healthcare, PPE and things like that, and securing vital ingredients for a domestic economy. There's absolutely the United States, but it's true in Canada and elsewhere, reduced fiscal capacity in the aftermath of this crisis, at least from a long-run standpoint. The US-China trade relationship has deteriorated for the foreseeable future. It's a Cold War right now. It can heat up, and of course you have been caught in the middle to some extent. Deglobalization trend has accelerated and widened, and COVID has increased that trend or accelerated that trend. The US budgetary position, as I mentioned, has eroded significantly. Pressure to reduce the debt to GDP ratio is going to develop at some point, and that's going to impede sustained economic recovery. It's a little bit like 1994 in Canada in a way, in that it's just inevitable. There's going to have to be some fiscal consolidation at some point in the next few years. And of course, we shouldn't lose sight of the fact that appointments to the Supreme Court and the US federal courts could have a significant impact on the business sector itself. There's a number of issues that are facing the court system in the United States that will have an impact on the economic outlook and select industries. So, and those are under the jurisdiction to a considerable extent of the next administration as well. So, that's important. So just finally, conclusions. It's Biden's race to lose right now. There's still time for, changes in COVID or changes in the economic landscape to affect the election. Not much, obviously. If we get a Trump win, it's going to be very close. It's going to be, it's going to be a nail biter, and there's going to be an awful lot of contesting of an outcome, of a close outcome. But that's the only way Mr. Trump can really win. It's possible we could get a big win for Mr. Biden, maybe sufficiently that the litigation to contest the election will be limited of both magnitude and duration. But it's only Mr. Biden that has the potential to win big. I still think capital markets would prefer a Trump victory. Maybe that's changed in recent days. They'd feel more comfortable if Trump wins, but the Democrats retain control of the House, which is most likely. Markets can live with Biden, and you know that because Biden's been in the lead for quite some time. But I think what's underappreciated today by the markets is what the ramifications might be of a Democratic sweep and how the markets would start to focus on that. The markets right now are comforted by the fact that a Biden administration is going to increase the odds of fiscal stimulus, but they also have to remember it's going to increase the odds of increases in taxes, which markets don't like. There's still potential for us to have a lot of volatility between now and then. Obviously, every day is a volatile environment these days in US politics. But that volatility is not just at the market level, but about sectors themselves, because uncertainty about the election outcome means uncertainty about healthcare, energy, banks, all sorts of important sectors. And again, just a final conclusion, our perspective is, look, it does look like an economic recovery. We expect an economic recovery to be sustained, middling per se, and that's normally positive for equities. But the reality is, even though we've got very strong monetary support, it's not an environment in which a full-on pro-growth portfolio posture is appropriate as it would normally be at this stage in an economic recovery process. There's still too many underlying economic issues. There's still the vaccine, and there's still a lot of political uncertainty. So it's, it's time still to be appropriately careful. There will be plenty of time, if this is in fact going to be a multi-year economic expansion, to get back on board the equity train. So with that, let me conclude. Thank you very much for listening, and I'm happy to take questions.
Thanks for that, Peter. Again, a reminder for everyone, just if you have a question, please type it into the Zoom group chat function, and I'll ask on your behalf. As I don't see anything right now, though, I'll start one off. You kind of put this in your conclusion, but maybe if you could expand a bit more. The equity markets are kind of 5-week highs here. Should we be cautious that investors are getting a little too bullish on Biden?
I mean, first off, I think the markets tend to look at polls. I mean, the markets are pretty sophisticated. There's at least a large number of them. We don't know exactly how many retail investors are help stoking the market now, but I think the markets are too upbeat about Biden's chances. And as I said, I think they're underappreciating some of the potential ramifications if there's a Democratic sweep. Because yes, getting fiscal stimulus is important, although rest assured, it's not necessarily, it doesn't come on November 4th just because Mr. Biden wins. But there are other elements to his overall policy package that the markets, I think, would be a little bit disconcerted by. One of which is, he's talked about raising the capital gains tax for the highest income earners to the highest, the same level as the highest personal income tax rate. Well, that's going to, that could potentially trigger considerable selling if you want to make sure that you've sold all your big winners before the, capital gains tax came into effect next year. Now, people may not know for sure, but nonetheless, I think markets are a bit too exuberant about the prospect of fiscal stimulus just because Mr. Biden's got a substantial lead.
Looks like we have one from the audience here. The topic of the US dollar debasement has increased in the news quite a bit. Will it be accelerated with any of the two candidates, and any insight you can provide there?
Well, I mean, our house view is the dollar is expensive, particularly on a real trade weighted basis, and it's likely to come down over time anyway. And more generally, the US just doesn't have the same weight in the global economy that it's had in the past. But the alternative is to say, look, the dollar is the world's reserve currency, and you can't really vacate the dollar until you can find something to replace it. And the renminbi isn't going to be a replacement for the dollar anytime soon. The euro isn't likely to be a replacement for the dollar either, but the euro has potential to rally if we have a global economic recovery because the euro is cheap and it tends to be pro-cyclical. A debasement of the US dollar, I mean, Europe, the ECB is conceptually debasing the euro maybe to a lesser extent, but there's less cohesion and less underlying confidence in the euro itself. So, I'm a little bit skeptical about this discussion of a debasement of the dollar because currencies are relative, but we do think it's going to be weaker over the next couple of years than it's been over the past few.
Okay. Another question here. What are your thoughts on the likelihood of a contested election? Presumably that would be negative for equities. Do you feel like this is a big risk?
Yes, and yes. I think the election will be contested anyway, because as I said, if Trump wins, it's likely to be close, and that means the Biden administration or the Biden camp is going to contest the election. And unless Mr. Biden wins overwhelmingly, then I'm certain that the Trump administration is going to contest the election. And the thing that's important about it is there is no real path when you contest an election for getting to a conclusion. The federal elections are not governed by federal election authorities, even for the presidency. They're governed really by the states. Now, the Department of Justice has tried to say there are some federal election guidelines that have to be upheld, but the reality is each state governor or executive authority is basically in charge of how you would adjudicate a contested election. And so, that creates 50 different possible outcomes at the state. Now, of course, not all 50 are going to be in play, but if you have 5 or 6 states where the outcome is very close, and you have different approaches taken by different states in terms of counting mail-in votes or not counting mail-in votes, trying to determine how much time they're going to give to do the counting, to do a recount, to determine which votes need to be scrutinized, individually, or can be, you can allow the computer systems to run things. There's any number of potential complications. Just conceptually, so you're aware that the Electoral College, which votes, meets on December 14th. So more than 5 weeks after November 3rd. So first, you don't get anything definitive until they vote, but it also gives you a broad guideline. Is you could easily have a circumstance where there's a lot of litigation and it takes until that December 14th date or even later to get a verdict. For those of you who recall, 2000, it took us a month to get a verdict, and that required a Supreme Court intervention. The important point is that, and this, that, unfortunately, I've been around a long time. I've never seen the U.S. as polarized as it is today. And, to have a circumstance in which you've got litigation in 6 or 7 or 8 or 10 states and different approaches being used to try to adjudicate or reach a conclusion for the individual states, with all sorts of uncertainty about mail-in voting and, voter repression and all of that kind of stuff, it would just be, not only agonizing for us all, but the markets would be thrown in an absolute loop, wondering about what's going to happen as the outcome. And, the reality, and I feel bad saying this, but you cannot rule out widespread violence in the event of a very close and hotly contested outcome across a number of states. You just can't rule it out. And of course, that would be bad for the dollar, bad for the equity market, good for treasuries perhaps, but bad for risk assets worldwide.
The debates have been a pretty hot topic since the first presidential debate. This morning, the commission was out saying next week's would be virtual. Mr. Trump, I think, responded saying that he would not partake in that as it is a pro Mr. Biden move. Mr. Biden, I think, has since come out saying that he will take voter questions in the time. Do you see another presidential debate happening, and does it even matter to the election at this point?
Well, I think another debate is likely to happen, simply because, because they're supposed to happen, but equally importantly, Mr. Trump is going to want one because he trails by a significant margin. He didn't do well, at least according to the American public, in the last debate. So ordinarily, you would think he would take any opportunity to give him, any opportunity he can get to try to narrow that lead and maybe reverse some of the perspective that came from the last one. Ultimately, I think the second one will be held in some way, shape, or form because Mr. Trump will want it, and because Mr. Biden will feel compelled to participate in it if Mr. Trump can agree to whatever ground rules they have. And of course, there's another one on October 22nd, I believe. So I suspect that one will probably be held as well. The conventional wisdom is that, except in a few circumstances, debates have rarely had a big impact on voters. And it's possible this time, but I think really when you look at the American public, most people have probably made up their minds. A few people might be swayed by a debate outcome, and a few could matter if it's in a number of swing states. But my suspicion is it's not going to be the deciding factor. But again, I think they will be held because Mr. Trump, it's to his advantage to try to engage in them because he's behind, and they give him an opportunity to try to either demonstrate Mr. Biden's inabilities or restore some of the standing he had prior to the last debate.
Yeah. I guess it's likelier that we're going to get a blue wave potentially result here, even if not, but maybe comment on what that might mean for rates markets if you could.
Well, I think so. First, it depends on a lot of things. But what I would say is, if you have a sweep, right, the perspective that for the rates markets will be Biden's going to have more fiscal stimulus, which is also going to have more inflationary consequences. Monetary policy is going to remain supportive for the foreseeable future anyway. So that's not really going to change the Fed's perspective or even the market's perspective on the Fed per se, because it's going to be far enough down the road to not matter. But you will see, I would expect that you would see inflation expectations move higher and real growth expectations move higher. And so the long end of the Treasury curve moving higher, more so at the 30-year than the 10-year. But all across the board, I would expect the curve to steepen a bit. Of course, the Fed wants to make sure that it doesn't steepen so much that it starts to undermine some of the benefits that might come from fiscal stimulus. But I think we would see nothing on the front end meaningfully, or actually nothing on the front end, but I think the longer end would start to move higher if you get a blue wave.
Okay. I don't see any more questions here, so maybe we'll wrap it up there. Thank you very much to Peter and MRB Partners for setting this up with us and speaking to us. We really appreciate it.
Thank you. Apologies for the the technical difficulties, but hopefully they weren't too disruptive.
Yeah, it worked out. And thank you for everyone for attending. We will be sending out a survey. Please take some time to fill that out. We will also be sending Peter's presentation, and as a thank you, 6 weeks access to their research. And that is it. And so please enjoy the rest of your day. Thank you.
Thank you.